What happens when computing power becomes important enough that companies start hedging its future price? For years, artificial intelligence companies have worried about getting enough chips. Now they may have to worry about what those chips will cost to rent months or even years from now. Welcome back to Synthetic Politics. CME Group plans to launch futures contracts tied to rental prices for Nvidia H100 and B200 GPUs. If the contracts attract enough buyers and sellers, companies could hedge the future price of AI compute, much like businesses already hedge fuel, electricity, grain, and other important inputs. That sounds like a financial story. Underneath it is something more fundamental. AI compute is becoming organized enough to support a market for the risks surrounding it. Imagine an AI company planning a major project 6 months from now. It knows roughly how much compute it will need, but not what that compute will cost when the project begins. If rental prices rise sharply, the economics can change. A futures contract offers a way to reduce that uncertainty by transferring some price risk to someone willing to take the other side. Economist Thomas Sowell uses a similar example with farmers. A farmer planting wheat knows how to grow wheat, but doesn't know what the harvest will be worth. That uncertainty already exists. A futures market doesn't create it. It allows someone more willing or better positioned to bear the price risk to take some of it. The same logic can apply to compute. An AI company can specialize in building AI products without making its success depend as heavily on a bet about future GPU rental prices. Before that can work, however, compute has to become measurable. An hour of GPU access isn't automatically identical everywhere. Prices vary with the chip, location, cluster size, networking, contract length, and provider. Silicon Data has been building standardized on-demand rental price indexes designed to turn those differences into comparable benchmarks. That's important because markets usually need standardization before they can efficiently trade risk. Chicago learned this more than a century and a half ago. In the mid-1800s, grain markets were fragmented. Quality varied, storage was inconsistent, and prices moved with harvests, transportation, weather, and local supply. The Chicago Board of Trade developed standardized grades and trading rules. By 1865, standardized futures contracts allowed farmers, merchants, and processors to trade the future price of grain without negotiating an entirely new contract every time. The breakthrough wasn't making every bushel identical. It was agreeing on standards that made different shipments comparable enough to trade. The same basic process may now be happening with AI compute. An H100 hour isn't literally identical everywhere, but standardized benchmarks can make compute comparable enough for finance to build contracts around it. Futures markets also produce something valuable: information. Economists call this price discovery. Buyers and sellers bring different expectations about future supply, demand, scarcity, and technology. Their trades combine those expectations into a market price. Milton Friedman argued that speculation is not automatically destabilizing. Someone who believes a price is temporarily too low has an incentive to buy. Someone who believes it is too high has an incentive to sell. When those judgments are correct, trading can push against price movements rather than amplify them. Speculation can sometimes increase volatility, but speculators can also provide liquidity to businesses trying to avoid price risk. Someone betting on future GPU prices may therefore help an AI company avoid making the same bet. A functioning futures market could also tell us something about expected compute scarcity. If future H100 rental prices fall below today's price, markets may be anticipating more supply, newer substitutes, or declining value for older hardware. Higher futures prices could signal tighter expected capacity. Over time, those signals could help inform decisions about building data centers, buying GPUs, or locking in compute. There is an important caveat. CME plans to launch these contracts pending regulatory review. That doesn't guarantee they'll become liquid or widely used. CME Group is also an investor in Silicon Data, whose index the contracts will settle against. That doesn't invalidate the benchmark, but it is a relationship worth disclosing. And no index will perfectly match every company's actual compute costs, so hedging won't remove every price risk. Still, the attempt tells us something. AI compute is becoming an economic input important enough to benchmark, budget, finance, and potentially hedge. The AI economy has spent years trying to create more compute. Now markets are beginning to create institutions for managing uncertainty around its price. Mature markets don't eliminate uncertainty. They create ways to measure it, price it, and decide who carries it. Do you think compute futures will become a real part of the AI economy? Or is this market still too young to trade like a commodity? Let us know what you think below. If this breakdown was useful, hit like and subscribe to Synthetic Politics. We'll be back when there's more to report.